right, Troy. Thanks for hopping on for part three here.
Thanks for having me. Good to see you.
Yeah, nice to see you as well. I know we were just talking about getting into the final stretch of the year. Everyone kind of has this timeline of I need to get something done by Christmas or something done by New Year. Sometimes it's the case, sometimes it's not. But I'm sure you're going to be busy as well the next few weeks until Christmas hits.
We expect to be busy. It's
Yep.
it's a busy Q4 for sure,
Yep.
and maybe for no real apparent reason. You know. But yeah, we're I mean, knock on wood, right? We don't lick the gift horse in the mouth. We're busy, and we expect it to continue. And frankly, and I know we'll get into this, we expect it to continue into 26, which is great news.
hmm
Great news both from a macro perspective and a micro perspective. So yeah.
How much of your Q4 activity ends up being the jump start to Q1 typically?
Yeah, it's a great question. It's a good thing that each quarter is 3 months long, um, because what can happen, especially in Q4 traditionally being the busiest time of the year, the second being really Q2. As we head toward the summer break, people want to try to get their deals closed by the end of June so they can sort of breathe, heading into July and the summer months. Q4 is typically busiest really for a few reasons. It used to be when there were public companies and they were out capital raising. We'll talk about that a little bit too, I'm sure. They wanted to either add some debt to the stack or add some window dressing as they went out to do other, additional capital raises. That's waned a little bit. Again, we'll talk about that, but it's still busy. We still have both bank and private credit providers that are deploying capital at a pretty, rapid pace, pretty steep pace. But invariably, and notwithstanding the fact that a lender will tell us this thing has to close by year end, it has to close by year end. The first part of the first quarter every single year is heavily populated by deals that had to close at the end of the prior
Yep.
year and just didn't. And look, sometimes that's for very credible, very legitimate reasons. Sometimes it's where the holidays fall in the calendar, and you'll get weeks of disruption as a result of a Thanksgiving or a Christmas, Hanukkah, whatever holiday falling midweek, and it's just disruptive to getting deals done. Sometimes it's because something has come up in diligence at the last minute, or something has come
hmm
up in a lender, site visit kind of thing, and people retrench, regroup, and come back, and we pick it back up in January. But we're fortunate that we have that experience. Sorry, let me send that away. Because, as it suggests, we're busy with the start of the year, and that's good news, and it's always a good start to the year.
Do you tend to see who do you see tends to be more focused on these Christmas or end of year timelines? Is it the borrower side or the lender side?
It's a great question. The negative, side of me wants to say, well, it's just a lender that's trying to get paid. And they want to force their deal through. And there's some truth to that. That's not, entirely, that's not the kindest frame of that experience, but nonetheless, there is a part of that that's being driven by the lender and the desire to close their deals and have a good year themselves and hence get paid off of that. There's also a very, real experience where borrowers are very forcefully demanding a year-end close. We're working on a transaction, for example, right now, a borrower side deal, a pretty large multi-hundred-million-dollar syndicated credit that has a part of it is taking out an existing lender, and that existing lender has a prepay, and so there's some need to take care of that financing in this calendar year in order to eliminate, reduce, whatever it is, that. And we see that experience with some frequency, that there is something that is driving the borrower's desire to get their deal done by the end of the year. Um, Nonetheless, best intentions aside, even those deals that had to close by the end of the year sometimes will slip, again, for that variety of reasons I described. Sometimes for no reason at all. Once in a while we'll get someone will let slip, like, well, the CEO or the CFO is going on vacation and they're going to be in Spain and unreachable. It's like, oh, okay, now we know why, what's really driving the timing. And,
Yeah.
and that's fair too. Everybody should get their vacation, their time away.
Yeah,
It's 50-50, lender and borrower.
Yeah, I think we've only ever closed maybe two transactions in December, but January has always been our busiest month
Interesting.
for closings because
For everything that didn't get
it's
done.
everything that
Yeah.
gets rolled over, and even when both sides are working toward it, it's you have accountants, board members, attorneys, convertible note holders, senior lenders.
A
They're
lot of
all
cats to herd
yeah.
to get to the close. Yeah.
Exactly. So what we found is usually by December 23rd, they start saying, you know what, we'll see what we can get done next week after the holidays, but this is probably going to be a January closing
Right.
timeline.
I agree. We have a that's probably about the same time frame that we think about that we're going to know by about the 23rd what's closing this year and what's not. And then
Yeah.
our job is in part to help others be realistic about what's actually going to
Yeah.
close and what's not. And then even when we think we're being realistic that hey, there's no way this thing is going to close, somehow still someone forces and we have to close the deal. And it is what it is. We know that as lawyers, as the service providers in this industry, we know what we've signed up for, and we know that
Hmm.
in many respects it's entirely out of our control. And our goal is to get the parties, the lender, the borrower to the goal line, and usually that means moving that pile of money from here to there. And if it
Yep.
has to happen on 12/31, okay, we'll be there. So
So, we are talking here in early December. So, I, had a meeting before this, and the group was just trying to understand a little bit more about private credit and how it's grown, and the different sectors that we operate in. So I want to talk through a little bit about what we saw this year, some of the highlights, both positive and negative, and then I do want to wrap up here with talking about what we think 26 will hold, maybe some predictions, at least for the first half of the year. And, I want to start with the private credit industry as a whole. You and I tend to play more in the venture space. We're not dealing necessarily with the $1 billion plus transactions you tend to see, on the news. But, there have been a lot of comments and reports coming out lately around the risks of private credit, right? They claim how opaque it is, can create risk compared to what banks have to report on. You come up with a million different reasons why it's viewed as risky. Obviously, everyone points to a couple of big transactions that recently had challenges. Obviously, for every one of those, there are 25 others that are going
mm,
perfectly well.
yep, yep.
But I want to address that. How you see, or how would you address that when someone says, the private credit market is growing too quickly? They're doing deals that they shouldn't. There's no clarity or reporting transparency. How would you respond to that?
Yeah, again, it's a great question. It's a great and really important topic, and I think a couple of things here. One, and I think we talked about this before, what we call private credit, which sounds like it's something new and interesting, really isn't all that new or interesting. Private credit as an industry has been around for a very long time, for as long as there have been non-bank lenders providing credit. That's private credit.
Hmm.
We just happen to have decided that we should give it a name in the last, couple, 3, 4 years. And it sounds like it's something new and interesting. And now, to be clear, so no, it's not new, but it is much, much larger and in some respects much different than it has historically been. I won't get too far into that. And so, as a result of getting much, much larger, it tends to grab headlines. And especially it tends to grab headlines when things go wrong or badly. It's rare that there's a positive report on the news because it just doesn't sell. The good news network doesn't exist for a reason.
Yeah.
Um, but you're entirely right. There's been a tension, especially I think it may have even been this fourth quarter. It may have been in the third quarter of in the sort of auto industry adjacent, where private credit was sort of deeply involved in a couple of facilities, and there was fraud that's still alleged, but very strongly suspected that there was fraud in the procurement of the private credit facilities. And the argument and suggestion and fear, I suppose, was that the private credit providers should have known that they were being defrauded, et cetera, et cetera. And again, it grabs headlines because the numbers are large and because bad news sells. But I think your comment is really, really right. For every sort of one like that, you said 25 that are going well, at least 25 that are going
Hmm.
well. There's another part of this context which is really important in sort of the overall lending landscape for 25, and that is, and I think we talked about this in a prior session as well, that um, broadly speaking, lots and lots and lots of bank deals, non-private credit deals got done, have gotten done, will continue to get done in 25, much, much smaller checks, fewer private credit transactions, but much, much larger checks. And so necessarily the private credit has sort of an outsized chunk of the overall lending that's occurred in 25. By the way, that's not at all a surprise. Nobody should be surprised by that. But again, given the fact that they're writing much, much larger checks than the banks are, they get much, much greater attention. This one was compounded, as it were, also by the fact that there was a chairman of a very large global financial institution who was sort of pointing the finger and saying, private credit is bad, or should have known better, or they're not diligencing well. Kind of an interesting sort of sideshow to what was actually going on there. Um, Look, I think the takeaway for borrowers is the same thing that you and I talked about in our last session, which is this sort of notion of transparency and communication, et cetera, et cetera. Um, Unfortunately, like I have this experience from time to time. Quick side note, right? Where
Mhm.
where a lender will say to me in connection with documentation, like, well, we need to do X because what if they attempt to defraud us? We got to be sure that X. And my response is always like, look, if we have a fear today, as we're entering into this transaction, that this borrower might defraud us down the road, we probably should be thinking about whether this is a credit we want to extend. That's not usually what the lender is actually thinking. What the lender is actually thinking is, let's be sure we protect against X and Y and Z, all of which are totally fair. But for as long as there will be human beings interacting, including in credit transactions, there will be fraudsters, schemers, et cetera, who try to take advantage of the system. That is to say, could those private credit providers in this very specific instance have done a better job of diligencing the underlying transaction and the actors, et cetera? Maybe, but maybe they were sufficiently adept, that is the principles underlying these transactions, at in fact engaging in defrauding lenders, that the lender wouldn't have known it was going to get defrauded, right? So again,
Well, I also one thing as well. Think about how many equity transactions you hear about where the reports were wrong.
right.
They just did no homework because they're like, oh, it's going well. What's the worst that could happen?
Right, right. Well, and ironically too, that same global financial institution which pointed the finger at the private credit providers in that set of transactions itself was the subject of fraud by a fintech company, an early stage,
Yep.
growth stage fintech. And the allegation and the conviction of the founder was that she, in this case, they perhaps overstated the customers in order to achieve a much higher price, a purchase price, by that financial institution. So financial institution buys a venture-backed company, fintech, to load onto their platform and gets defrauded. So
Mhm.
point is, it happens, right? There is fraud, but the incidence is extremely low. It's still extremely low. So sure, very big check, very painful. That auto industry adjacent set of sectors, set of businesses, excuse me, um, uh, is a very large check, but is an absolute outlier.
Yep.
Uh, I don't think, for example, I don't think the takeaway is, oh my gosh, we should be very afraid. But the result when lenders, banks, private credit, whatever, get defrauded is they start taking a much closer look, right? So the
Yep.
diligence dive is a little bit deeper. And so no one should be surprised, no founder at any level, very early stage to more mature, should be surprised that the diligence experience is just that much deeper. Um, you can't say to a founder, hey, could you please check the box that you're not going to defraud us, right? Because if they're going to defraud you, they're not going to tell you that they're going to defraud you. They're just going to defraud you.
Yep.
But there are other ways, right? Let's do a deeper dive into the recurring revenue and to the customer base, and we're going to do deeper customer calls than we might otherwise have done, et cetera, et cetera. That's how that turns out. The quote unquote chilling effect, if there is one at all, is minor and short-lived, and that's what we should
Yep.
expect, minor and short-lived. Private credit will still write, as we look into 26 now for a second, and we'll come back to where you want to go. We should still expect that private credit will be an outsized provider overall to the credit landscape.
Yeah, I mean, I think over the past, this year in particular, but even over the past couple of years, companies have just adapted to a higher cost for everything, including capital. And, they're continuing to see the attractiveness of the private credit options out there. And, they're deferring equity raises because even though it might give them a better valuation, it's, well, let's pay, X% in a loan cost and we don't have to put a valuation in the company at all right now, and then maybe we'll sell for even more, or we'll just continue growing for the next few years and we won't have to sell another 10% of the business to get to there. And so we've seen companies, investors, even other service providers really open up and say, okay, there are more than a handful of banks and a handful of funds out there. There are, even in the space you and I play in alone, dozens and dozens of firms that focus on those 2 to $50 million checks to venture back growth stage companies. So we're seeing the market grow quite a bit. Now, obviously, you go north of 100 million, you have all kinds of different players, but within the area you and I focusing quite a bit. I mean, I'm talking to funds, they're constantly raising more funds. And, they're not having a hard time on their end deploying or raising. So I think next year is going to be even busier than this year from a dollar amount perspective. And a lot of the firms we deal with don't actually fall under a lot of those reporting, like for PitchBook and all those other stats out there. When you're writing on average like a $5 to $7 million check, you're not really following under the radar typically of the PitchBook reports out there. And a
Mm-hmm.
couple of
Mm-hmm.
firms we deal with are technically classified as private equity funds because they're kind of half and half. So their credit checks don't even get allocated. And some of these firms we deal with, they'll put out, 100 million a year. That does factor into, what is it, a $50 billion industry? I think that you and I operate in. So
Mm-hmm.
yeah, it's interesting to see how much falls below the radar and still it's growing.
Yeah, and I think, part of the growth that we've seen in, a little bit in 24, certainly in 25, and as you and I think about 26, is related to the fact that notwithstanding that, well, you and I can maybe agree, or your audience might agree or disagree, is an outlier, the private
Mhm.
credit outlier we just talked about, the rate of loan losses in private credit is extremely low still. So it remains an extremely attractive asset class. And while venture capital investment has picked up a little bit in the second half of 25, not so much, not as much as anybody I think would have hoped, both companies, banks, et cetera, excuse me, lenders, but not just banks. Um, uh, sort of the layering of debt continues to be an attractive asset class, even while we wait for the capital markets to return in a robust, public market, et cetera, et cetera. And, I remain hopeful, two fingers crossed, that 26 sees that tide turn a little bit. I was talking to somebody the other day who was talking about the fact that it's the 20th year of Sarbanes-Oxley SOX, which made it painful to be public. And so there is still pain in being public. And so companies too need to think about, is it worth it? Is that, do I
Oh
really
yeah.
want to pursue being a public company, knowing what Sarbanes-Oxley and otherwise the public reporting and the public scrutiny and all those kinds of things mean for me as a company? We'll see whether the incidence of companies going public slows or reduces because of the desire not to be public, not to mention sort of where the market is broadly. We'll see.
Yeah, I mean, I read reports and hear on the financial news all the time. Companies, you know, take the reasons the past few years aside, but companies are just staying private longer. To your point, there are all kinds of private capital options. Why subject yourself to an institutional investor, a corporate raider, a hedge fund that's shorting your position, or a bunch of retail investors that honestly just follow the Reddit rumor mill,
Right.
and determines your stock and there are a lot of companies that I've been reading about where they're like, well, we want to continue growing. We don't want, yeah, we need to manage cash. We're not going to burn all of our money, but if we're going to be measured by our profitability and all these earnings per share ratios and things like that, we'd rather just spend another 5 years growing the business because we think we can do a lot more. And founders, if they're still in the driver's seat, they want to be able to do what they want to do and not be subject to not only public investors but also all the reporting requirements, like you were saying, that comes with it. And it just adds another layer of
Yeah.
administrative duties.
Well, and these days too, the last few years, the sort of total raises at IPO. So the first, the true IPO of a company, generally speaking, have been much, much smaller than in prior years. And
Oh yeah.
like everybody else can read, we'll see, oh yeah, this company went public and they raised $50 million. And like, in the old days, whenever that was, you'd be like, $50 million. Oh my goodness. Now that's like saying $1 million, right? And my point is, whether it's 50 or 100 or 250, to your comment, we're seeing private credit providers write that check. Now,
Yeah.
granted, it's a different risk profile, it's a different underwriting analysis, it's a different repayment, right? If you're raising equity, that seeks to deliver a return, a dividend. If you're taking on debt, you have to repay the debt. It's extremely important for the
Yeah.
audience to appreciate too. I'm sure they all do that. Venture debt is not disguised equity. Venture debt has to get repaid. And we still call it venture debt when we're seeing lenders write these huge checks. Maybe it's a misnomer, doesn't really matter. But the point is that if you're going to go public and you're going to raise $50 million, you really have to ask yourself, is it worth it? Is it worth it?
Well, I
Um,
remember in 2018 and 2019, there were these reports coming out that companies were starting to, question their bankers. And this was everything from boutiques through the big guys. They're like, well, it's great that my IPO I'm surging. Some of these companies, I remember they were up like 70% on their opening day. And, they'd always, come back down over the next couple of weeks. But a lot of these companies are like, why wasn't I priced 40% higher?
right.
So, a lot of what I know companies were talking about before COVID hit and the markets did what they're doing, they're like, well, why would we do that? Because our bankers, they don't want to have an IPO that doesn't grow 70%, but am I leaving money on the table at a $10 billion valuation? Should I be at a $15 billion valuation considering opening day I closed at 18 and a half? I'd rather,
Yeah. Yeah.
not sell at such a low valuation in the public markets opening day.
Yeah, it's and look, this is not my area of expertise, but
Mm,
observationally, I will say there are psychological aspects to the pricing. The pricing is almost always a guessing game. It is usually a matter of what is a willing purchaser, right? The
it's
initial
not some perfect
underwriters.
science that
Right,
the bankers
right,
developed.
right. And so it is easy to go, oh my gosh, it bumped 70%. I should have priced much
Yeah.
higher. But there's also the psychological aspect, which is to your comment, like, well, look, we had a very successful IPO, right? Very successful, knowing
Hmm.
that, as you say, 2 days later, 70 is down to 12%, over initial price, et cetera, et
Yeah.
cetera. But there's definitely some psychological, if not philosophical, aspects to the pricing for sure. And that's from a pure observational perspective. Your mileage may vary. I'm not an expert in the public markets.
Uh, so, what are some of I don't know if you want to call them themes or trends that you saw in 25 that either worked or didn't work? Some things that make you optimistic or concerned as we wrap up the year looking ahead to 26.
Yeah, it's another great question. I overall, and I've made this kind of comment before in the prior couple of series, and to the audience, if you haven't seen the prior couple of series, I would encourage you to go back and look at session one and watch and listen to session two. Um, we've had a better year than I think we ever would have expected. Now, when I say we, what I mean is my team and I see the deals that we see, right? So we know we have a chunk of the market. We don't really know what that reflects as a percentage of the whatever we even want to call this market that I operate in, private credit and venture lending, commercial credit, whatever. Um, and so my perspective is by necessity myopic because I only know the calls and emails I get on the deals that my team and I
Mm,
do, right? So, but I do know because we measure, among other things, as lawyers at firms by sort of revenue and year-over-year growth, that we're having a phenomenal year. I knock on wood, and I don't take that for granted by any stretch of the imagination. And year over year, from a revenue perspective, up by probably, gosh, 25 or 30%. Okay, so if that's indicative of the market, and I'm not suggesting it necessarily is, but some percentage of that growth in our revenue is as a reflection of an increase in the market, even if it's half that number, a year over year increase of 12 to 15% is pretty phenomenal.
Yeah.
Again, those are, I'm sort of making this up in the sense that those are not hard and fast. We don't have the PitchBook data to your earlier comment
Yeah.
really in this space at all. We could really use it. Side note, it'd be great if somebody out there could actually collect the data on venture lending. Um, um, but I would say that one of the surprises, now to your question, is that what all of the uncertainty in the political landscape, the sort of global landscape, wars, tariffs, we talk about that throughout 2025, how that was going to impact the lending sort of landscape, broadly speaking, venture lending, private credit, it's a commercial credit, and beyond. And I would say that the sort of market outperformed it, outkicked the coverage, to use that expression, right? The number and dollar size in aggregate of deals in 2025, I think, is a surprise by any measure, given the uncertainty, given those things, given war,
Yeah.
given a new administration, given tariffs, et cetera, et cetera.
And I do want to highlight, we
Yeah.
do have some data that I'll probably have the team post along with this, but what you said is accurate, even if you exclude those anomalies or the outliers, excuse me, those $400 or $500 million loans that go out.
Mhm. Um, and so, look, oftentimes we see, and going back to your comment about like the public market and a price increase, and we hear people say when the market either goes up or down, well, that was on, or what news was that on? Answer, oh no, that news was already baked into the market. Like, well,
Mhm.
okay, but at some point the market has to actually be reacting to some news. And my point is, maybe our credit, sort of market has been reacting to those things, tariffs and administration and wars and blah, blah, blah. And has been, in ways, if I'm right about the increase, sort of agnostic as to that experience.
Yeah.
And more importantly, as we head into 26, perhaps we sort of feel emboldened, like, well, it's going to be fine. We did just fine in the face of this uncertainty, the sort of known knowns, or maybe those were the known unknowns, not all that concerned as we head into 26, in fact, feeling more bullish about 26. And that's where I sort of come out, is that we've had the experience of these, these sort of major events. I won't say them for a third time, the ones I just identified, that we thought were going to, like, oh my gosh, the market is going to, either it's going to take off, which it didn't, or it's going to tank, which it didn't.
Mhm.
And so maybe we walk into 26 actually feeling pretty good that, like, well, the market, whatever that means, can actually sustain whatever comes at us from the sort of the outside, whether that's tariffs or wars or whatever. Why? Because we just did. Um, it's not so much that history is entirely indicative of what the future will be, but it's a pretty good teacher, right? And not to be ignored. And couple that with the fact that we still hear and see reports with some regularity about all this capital still on the sidelines to be deployed, venture capital firms and private equity firms itching to do deals and sitting on pools of capital, starting to do a little more deals in the second half of 25. And by the way, a public market, which also is itching, notwithstanding our comments about do you really want to go public, but plenty of companies sort of in the
Yeah.
pipeline to go public. And I think that conspires positively to a very robust macroeconomic environment in 26, I think. We still have concerns about interest rates, the interest rate environment, but I think that's one of those factors that we experienced in 25 that we were sort of scratching our head and sighing about, oh my gosh, the interest rates are high and the Fed hasn't reduced the rate. We thought they were, and the signals and
Yeah.
blah, blah, blah. And we still are having and have had a great
Yeah.
year overall, right? So that too is sort of baked into 26, and that sort of fear or anxiety about interest rates. Like, sure, I would love for the macroeconomic environment for the interest rates to come down, but we've learned that we can continue to have a robust credit market even in a higher interest rate environment.
Yeah, and most of the deals that we work on are private credit placements. And to be honest, I the higher rates I think helped in favor of the private credit because they were always more expensive. And it used to be,
Yep.
I can get a 3.5%, or I think the lowest I saw a few years ago was 2.8% bank loan. I mean, it's basically a mortgage at that point for a venture-backed company. And companies would come to me and say, hey, I got a $5 million offer from this bank, and it was something like 2.9%. They're like, well, what can you find something that'll beat it? And I'm like, no, even if I find
No,
you
take
twice as
that
much
deal.
money,
Take that
the
deal.
math isn't
Yeah.
going to work. But
Right.
a few years ago, I remember I was running a process for a company. They had, they were evaluating two offers: one bank, one private credit. And the way the bank had structured theirs, it was actually more expensive than the private credit. Now, obviously, that spread has increased a bit as rates have come down over the past 14, 15 months. But even still, average private credit we're seeing is anywhere from, it used to be about 10 to 12%. Now it's more like 11 to 13%, which, all things considered, that's not bad. If you
Right.
get things like little
Right.
to no covenants, 4 times as much capital we're seeing sometimes on the higher end compared to a bank offer. So we're still seeing a lot of activity, and companies
Yeah.
are leaning into it.
And look, you know what, and you know this well. I suspect our audience knows this well, but it bears remembering that part of what comes with the higher cost of capital at private credit is also a much larger check, generally speaking.
Yep.
Oftentimes 2 or 3x what that bank is willing to provide. Um, there's a whole bunch of questions that go into that, but I would say, look, there remains uncertainty, right? Notwithstanding my comments about like, oh, it's okay, we can live with the uncertainty. There is still sufficient uncertainty in terms of where the credit markets will go in 26. I happen to be bullish about where I think the credit markets will go, but we might see additional fissures, cracks, even maybe worse. I certainly hope not. Not just the private credit stuff that we've talked about, but there's also this whole real estate market that's going on, and there were some real estate loans that were in the news too that had gone bad, and some banks that made those loans had took a hit, basically a 1 or 2 day hit. But there are those who think that there is a pending or an impending like real estate crisis that will affect the credit markets. I'm not sure. Frankly, I would have thought it would have been here about 5 years ago. I've been wrong a
Mm-hmm.
number of times, and I'm pleased on this one to be wrong. But what's my point? Look, a company has to really consider um, what they're getting in their lending partner. And you and I, James, talk about this a lot. And that is, you can look at 5 different term sheets, and at some point you have to think about who's my relationship partner, who's my partner in this experience. If they're all pretty close, we're looking at an 8 or 10% all-in cost of capital across 5 or 3 or 5 term sheets. Now I have to start thinking about how is my lending partner going to behave, not if, but when I hit a negative inflection point. So most companies think, well, I'm never going to hit an inflection point, so I don't have to worry about that. But that's really how, from my perspective, they should be thinking about that. When I hit a negative inflection point, how are they going to behave? And the other thing to consider is if the bank is going to write me a $5 million check or make available to me 5 million, but my growth trajectory really has me needing 10 or 15 in 12
Mm-hmm.
or 18 months, and I don't really have the certainty from my bank provider that I'm going to get there, and it's only going to cost only, it's easy for me to say, 2 or 3 points more to get the certainty of 15 million. I'm just making these things up.
Mm-hmm.
It's really important to think about, does it make sense for me to pay that extra, percentage, to pay the extra freight to ensure that I've got the additional credit available to me?
We just
Um,
had a client go through almost that exact scenario with the exact same amounts.
yeah,
It was 10 million. They're like, we'd really like to have an additional five. And they're like, okay, we'll do a delayed draw, but we have to
right.
structure it this way. And they're paying a little bit more for an insurance policy. And the company's like,
Yeah.
that's great. I don't need to raise my Series B now.
Yeah. And, I think we're beyond the days when private credit, in definitely the pre 23 and probably ending about mid 22 era would write just a very big check that the company really had no business taking,
Oh
and the
yeah.
credit provider really had no business providing a check of that size. I think we're beyond those days now. I think there's discipline in the market really on both sides of that table that doesn't have us there. But I do think the scenario, and obviously, because you just said it, I wasn't aware that you had been looking at that, where it's 5 or 10 to 15 is realistic.
Hmm.
I mention that part because the discipline piece, I say this every time. I'm a recovering bankruptcy lawyer. I started my practice as a Chapter 11 restructuring lawyer. I've sort of seen this movie before. I see it on kind of both sides, both at the beginning and kind of the end when stuff goes sideways. And I'm a big believer in discipline. It's really important for the company to be disciplined in the same way that your lending partner is being disciplined and not writing you a $25 million check, that you not take on more debt than you can service.
Hmm.
And there are ways, and James can help you to structure your credit facility in such a way that you have the flexibility of greater availability, but you're not paying for 15 when all you need is 10, or you're not paying
Yep.
for all of 15 when all you need today is 10. Um, the discipline piece is extremely important. And again, I began this part saying sufficient uncertainty in the credit market. So when we're talking to companies, we're saying to them, hey, look, if 15 is the right number and that's your sort of growth trajectory, that's what your financials are projecting is your need, and you can service it and or you can afford it, you can pay the extra points to get you that additional number. There's sufficient uncertainty in the market that maybe that makes sense for you. But that's
Hmm.
absolutely a borrower by borrower, business by business analysis.
Yeah, we talk to a lot of companies when we're early on this time of year in the conversation. They ask a lot about what's going on. What do you think is going on for the next 12 months? And we had a discussion internally. And though I don't think it necessarily all has a direct impact on us, I think, like we talked about, everyone reads about the headline deals, the 500 million to $1 billion plus transactions. My theory is you're going to see, compared to this year, you're going to see a higher deal count in that $400 or $500 million plus range. I don't think it's going to be, an obscenely amount more of them, but I think you're going to see a higher deal count. I think we're going to see fewer of the 150 to $300 million deal sizes, and I think we're going to continue to see a lot more of the 10 to $50 million deals,
Hmm.
because we're still, the space that I play in are really the 5 to $50 million transactions. Once you get up a little bit above that, you're really dipping into the lower middle market for a lot of
Mhm.
lenders. And the lower middle market is where we're seeing the most hesitation. It really is the guys that used to write $75 million checks all day. Now they're saying, let's start at 45 or 50. To your point, let's not give the company more money than they can take on. But when it is that 10 to 40, 10 to $50 million deal size range, we're seeing a lot. That's where we get the most interest on the deals we're sending out now, is
Hmm.
right within that range.
Yeah, that's interesting. And you're much closer to the segmentation as you just described it. And I trust your judgment on that. I was thinking as you were saying that, yeah, that sounds about right. And then I was also thinking, gosh, I really hope for 26. So here's the pretend big, hairy, audacious goal for 26. I really hope that the sort of, it's not really a gap, but maybe it is, that the gap, or that what would otherwise be the larger check or the greater
Mhm.
number of deals, larger checks or greater numbers of deals, will be filled with venture capital investment, and or public market, right? IPOs.
Yeah.
So rather than the 100 to 500 million dollar checks, those deals that those really should be public market transactions. Those
Hmm.
really should be initial public offerings and follow-ons and those kinds of things when you get to that range. Like, again, that's in a way against my interest, right? We love those deals. I love doing those, and I mean
Yeah.
that. But from a macroeconomic perspective, at least historically, those are deals that are really public market deals. Maybe. And then likewise, in part, I always think about this sort of virtuous cycle that the private markets always follow the public markets. Once that public market engine gets going, the venture capital investment will continue to increase. As the venture capital market continues to increase, public offerings will continue to increase, and now we have this flywheel effect. I'm hoping, yet again, it's the end of 25, that that's close for 26. I would have
Yep.
thought, like many, that 25 was actually that year that we would have seen, increased public market activity and increased venture capital investment in 25. Turned out to be very modest by, I think, what
Hmm.
most people were sort of predicting. I'm hopeful that 26 is the year, gosh, I hope.
At least by 2030. I'll just tell everyone, yeah, at least
If
by
we're having this
2030.
conversation in 2030, I got to get a new job. But look, I think that you're right. I think overall, right, if you said to me like, well, this is the statistics for 25, what are you thinking about for 26? I would say to you, I agree. I think that we're going to continue to see increased checks, those much larger checks by those private credit providers. I think we'll see an increase in the number of the quote unquote smaller checks, the 2 to 50 as you described it, the sort of more bank sweet spot 5 to
Mhm.
25. So overall increase in number of deals and overall increase in total lending. Seems hard to imagine because the lending number is so huge, but as we
Yep.
said at the outset, that's in part because of those sort of handful of outlier private credit deals in the 50 to $250 million range. Um,
Yeah, I mean, my guess would be if you look at it holistically, you're going to see overall a steady increase, but I think it's going to look a lot different from the reporting because you are going to have these massive equity funds that have just shifted their capital to credit, and they are going to do those much bigger transactions. And then the guys in the lower middle market are going to go a little more risk averse, but they still need to put out, for every 100 million they need to put out, instead of doing that 100 million in one deal, they might do in 2 to 3 deals. So I think you're going to see headlines increase across the board, but if you remove the outliers, I think you're going to see a steady increase versus this explosion that everyone seems to be following in the news.
Well, and hopefully those headlines are all good news,
Yes.
and not bad news. And I'll place the first ad on your Good News Network television channel.
All right, sounds good. Yeah, well, that might be an idea for some content for us in
Right.
just a good news of the week.
Yes. Right. Right. It's a very short segment, but yeah.
Well, I appreciate you doing this little series with me over the past couple of months. And any final words before we wrap up here?
Glad to be included. Thanks for giving me the
Yeah.
opportunity to do this. Always a pleasure to talk to you. As you know, I sort of geek out about this stuff. Even after all these years of being in the venture lending and private credit space, I still geek out about who's doing what and what do you think and
It's like
um,
gossiping in high school.
right, right, except super nerdy. I'm bullish, as I said. 25 has been better than expected, both sort of anecdotally and kind of from what we see on our desks, as it were. Uh, and I'm expecting 26 to be even better. I'm glad that our markets didn't get derailed by all of the uncertainty and all of the madness that prevailed in 25. And I'm hopeful, as I said earlier, that news is sort of all baked in and we're just off to the races in 26. So thanks for including me,
Yeah,
James, and thanks to your audience for engaging with us. And happy holidays.
you as well. Have a good one.
Take care,
See ya.
James. Thanks.